All right, with chapter 6, what you want to get comfortable with is the bonds. When the parent company or the subsidiary company has bonds outstanding, and then the other parent company or the subsidiary company goes out and purchases those bonds. Where it gets tricky is rarely is it ever at 100%. You know what I mean? So the parent may issue them at a discount, and then the sub comes back and buys them at a premium, or vice versa. So I do number 61 in a YouTube video where I work it all out on the board. So please take the time to watch that. I'm going to look at number 62 here because the thing I like about 62 is it shows you the parent entries and the sub entries. So number 62 says the parent has 10-year, 10% bonds at a par value of $500,000 that they sold for $450,000 January 1st, 2011. Then on January 31st, 2012, 2 years later, the sub purchased 80% of those bonds at $400,000. So that'd be the face value of 80% for $410,000. So at a little bit of a premium. So the parent issued them at a discount, and now the sub is buying them back at a premium. The subsidiary had $100,000 of common stock, $70,000 of retained earnings. The parent owns them 90%. And then now we're trying to prepare our financial statements for 2013. So that is the year after they purchased the bonds. So the gain would have already been recorded, or the gain or the loss would have already been recorded in the prior year. Then they tell us that the sub's net income in 2013 is $100,000. They paid $25,000 in dividends. So then they say, okay, now what's the amount of the gain or loss? So I've kind of worked that out over here. I guess let me come back over here real quick. So here they kind of map out how they're amortizing. So like we said, the parent had a $50,000 discount that they're amortizing out over 10 years. So the carrying value would be the $460,000 at the time that the sub bought 80% of those bonds. Then when the sub comes in, they buy them at a $10,000 premium that they're going to amortize out over $2,000 for the next 5 years. So if we look over here, I've kind of mapped it out. You know, we had a $50,000 discount. We would have been amortizing for 2 years, $5,000 a year. So there would be a $40,000 discount remaining, which takes our net book value of the bonds to $460,000. We are only concerned about 80% of that because that's all that the sub purchased. So if we take the $460,000 and we multiply that by the 80%, that gives us $368,000. We compare that net book value to the $410,000 that the sub paid, and I'm sorry, it's not a gain. It's let me cross that off. It's a loss. So we would have a loss on the retirement of those bonds because we paid $410,000 to retire $368,000 of debt. So that is where then this is kind of coming into right here to show you that. Okay, then what we want to come down to is our journal entries. So here we have the parent would, at the end of the year, it's annual interest, they're going to pay the cash at the stated rate, the $500,000 times the 10%. They're going to amortize out their $50,000 discount for $5,000 each year because they're 10-year bonds. And then the interest expense would be the difference between those, the $55,000. Then this is showing what they're recording as their equity income. So if we look at that, that is going to be the sub's net income of $100,000, which it gave us. They own them 90%, which they tell us that as well. So they'll get 90,000 of that. And then plus the $6,000, which is the amortization of the loss. If you would take that loss of $42,000 and divide it by the 7 years remaining, I think you would get that $6,000. or as we look up, it's going to be the difference between the interest income and the interest expense. Now, the key to this interest income and interest expense is that we only need to take 80%. So let me come back over and see if I can work that out. Let me clear this. So if we take our 55,000 of interest expense and we multiply that times 80%, that should give us, let me come over to my calculator real quick. So that gives us 44,000. So let me shrink that down. Come back over here. So that gives me 44,000. And then I compare that to the interest income, which the subsidiary is recording, which is the 38,000. So that is where the $6,000 difference is coming in. So then this is the expense that the parent is recording, again, at 80%, because that's all we're concerned about. And then this is the income that the sub is recording. Sorry, my fingers not working that great. But then you can see, okay, so that's where this $6,000 difference is coming in, and that's what's going to be recorded as their equity income. And then this kind of maps it all out in total. But what we want to focus on is that 96,000 as we come down to our journal entries. So we're going to eliminate that equity income, that $96,000. We are going to, I guess we can look back up at that though, because that does map out our NCI. So then here, this shows you the net income attributable to the non-controlling interest, the $100,000 of the sub's net income times the non-controlling interest percent of 10%. So that's where this $10,000 comes in. They eliminate the dividends completely. The sub paid an entire $25,000 in cash. And then we set up the NCI share of the net income, and then the parents' adjusted share, their 96,000 minus 80% of those dividends give us the $71,000. So again, nothing too different there other than we just had to remember what I mapped out over here, that we are going to compare the interest income to the interest expense, and that adjustment goes against the figuring out what that equity income is. Okay, then our E entry is the same as what we did in Chapter 5. We eliminate the common stock at 100%, the retained earnings at 100%. Then what goes to the investment in sub is the 90% that the parent owns. The remaining 10% goes to the NCI. Then here's your entry dealing with the bonds. So then this is one that a lot of times I would set up into two different entries. They have combined them based on the just doing it as one entry. So you can do it this way as well, or you could break it into two. So this here, they're taking the bond payable off of the books at the 80% of the amount. So if we kind of go back up here, the bonds payable, whoops, did I go too far? No. So the bonds payable at December 31st, 2013, the net would be it'd be the 500,000 times our 80%. Well, that would be the 400,000. All right, let me go back down. But I believe then it's because we're amortizing that piece of it. So sometimes, again, when you kind of map these out, you have to look at the amortization level, because see, this is showing you it's net of that discount. So it really probably is after that discount is calculated. Then the interest income is offset to the interest expense, which is the amounts that I had over here, the 44,000 and the 38,000. You can see those coming in there. Then the investment in bonds is after the amortization is taking place. So that is $2,000 a year, 1 year has been amortized. So the investment in bonds would have started at 410, amortized it by $2,000 to bring it down to 408. And then the offset, this 42,000, let me come back over here. So if we had a gain of the 42,000, that is going to be deferred. I mean, it's going to be, it was recorded in the year of the sale. So then slowly it's going to be washed away. If we go back up to this, it shows us what was that total gain. So the total gain was the $42,000. So then that's what we see here. Over time, though, that is going to be reduced as we amortize out some of those interests versus expenses. But so then that's where that number comes from as well. So I think the one that's kind of tricky is just that bonds payable, because it is net the discount, and you have to look at what year we're at and then take that just times the 80%. So then make sure, though, because that's kind of what I'm going to have you do on your test. I'm going to have you do the parents entry, do the subs entry, and then do the consolidating entries only. And again, you can break this out into two if you want to. And then number 63 is another one you can look over. It doesn't map those parents and sub entries out, but then I do have that one worked out as well as it does, I mean, in here it's showing you it, but if you come over into your Blackboard, then you have it worked out as well, where we're going to eliminate the bonds payable. So if I keep going down, you'll kind of see where that's coming in on this I entry. We're going to obviously eliminate our common stock, our paid in capital, set up the NCIs for their piece of everything. And this one doesn't have an A entry, so that makes it a little bit easier. And then you're going to be eliminating your interest income against your interest expense. So if we go up here, you'll see those. So here we're taking the interest income off of the books. We're taking the interest expense off of the books. We're eliminating our entire equity income. Then we eliminate all of our dividends. And again, we piece it out because at this point too, it's one that is owned 80%, I believe, or yeah, 80%. So then we got to deal with that 20% NCI. So then this is out in Blackboard. So I would recommend you trying number 63, kind of working through like I just did in this number 62, where you worked out the parents' entries. And that is not the right file. Let me go back. I think it's over here. Yeah. So then take the time to work out how we came up with these numbers, and then let me know if you have any questions on that.